What stood out was that, once realistic transaction costs were included, the moving average, momentum, strategy not only held up but tended to outperform in most longer timeframes. In other words, buying when the shorter-term average crossed above the longer-term average, and selling when it crossed back below, yielded better risk-adjusted returns. I also read another study from a UK university that used intraday data to show that early morning volume spikes often predicted whether Bitcoin would close higher or lower by the end of the day. In practical terms, that means if heavy buying happens right after the Asian markets open, that momentum often carries through until the US markets open. When it comes to constructing my momentum signals, I have a few favorite tools. First, moving averages. A simple example I like is the 10-day exponential moving average, EMA, versus the 50-day EMA. Exponential moving averages give more weight to recent prices, so they react faster to new information than simple moving averages, SMAs. That responsiveness is important in Bitcoin, because the market can shift so quickly. When the 10-day EMA crosses above the 50-day EMA, I interpret that as a bullish sign, so I go along. When it crosses back below, I exit. In my backtests on daily BTC, USD data, I found that the 14-period EMA versus the 50-period EMA was a particularly sweet spot, fast enough to capture most moves, but not so fast that it kept flipping during minor pullbacks. If I were trading on an hourly or 4-hour chart, I might shrink those lookbacks to something like a 12/26 MACD or 20/50 EMA, because intraday momentum cycles are shorter than daily ones. Next, I often layer in the Relative Strength Index, RSI.